Hi, I'm Philip Smith, financial planner with Tidepool Wealth Strategies, helping self-employed professionals and solopreneurs just like you cultivate resilience in your plans to retire well. This is the Financial Planning Podcast about money management, best practices for long-term growth, wealth building truths and fallacies, successful retirement strategies, and more, where I'll be sharing concise, actionable retirement planning guidance. Welcome to the Financial Flow. Welcome to episode 16 of the Financial Flow. I'm Philip, and today we're wading into the tide pool of financial wisdom to catch a glimpse of how solopreneurs can navigate the choppy waters of financial risk. Whether you're a one-person show or considering going solo, knowing how to manage financial risks is crucial for long-term success. And before we dive into today's topic, if you find this episode helpful, make sure to share, like, and subscribe. Now, as the solo...
You forgot to mention that your sources will be listed at the end of the transcript and that the transcript serves as your show notes.
Yes, that's right. Thanks. Where would we be without our helpful reminders? As a solopreneur, you're the captain and the crew, and you likely built the ship that is your business. While that has potential to offer flexibility, it also means you're exposed to a range of financial risks that larger businesses might weather more easily. Here are a few of the biggies. First, irregular cash flow. When you're the sole operator, your income can fluctuate wildly from month to month. One minute you're sailing smoothly, the next you're bailing out water like there's no tomorrow. This irregular cash flow can make it difficult to cover fixed expenses, as I'm sure you may be aware. It also makes it difficult to save for the future or invest in growth opportunities. Here's an example. Let's say you're a freelance graphic designer. You might have a great quarter with several big projects, but the very next quarter could be really slow. Without a steady income, budgeting can be like praying for the next gust of wind to fill your sails and propel you forward to that next location. I'm sorry, but I'm probably going to ride this sailing ship analogy to the bottom of the sea today. Anyhow, financial risk number 2, over-reliance on a few clients. If a significant portion of your income comes from just a few clients, losing one can be like a torpedo to your hull. This over-reliance creates a vulnerability that can lead to significant financial strain if those clients decide to cut back or end their contracts.
Example, imagine you're a consultant and one client accounts for 60% of your income. If they decide to go in a different direction, how will you quickly replace that revenue? Fewer clients increases your potential for revenue volatility.
Third, personal liability. As a solopreneur, your business assets and personal assets are often intertwined. If your business faces a lawsuit or incurs debt, your personal savings, home, or other assets could be at risk. It's like sailing without insurance. You hope you'll never need it, but if you do, the consequences could be devastating. Another example, picture yourself as a web developer. If a client sues you over a project gone wrong, your personal finances could take a hit if you're not properly protected. Now that we've mapped out some risks, let's plan a course towards safety. Here are some strategies to mitigate these risks and keep your business on an even keel. Number 1, build a cash reserve. Think of your cash reserve as a life jacket. It's there to keep you afloat when the waters get rough. Aim to set aside enough money to cover 3 to 6 months of expenses. This cushion can help you navigate lean periods without resorting to debt or desperate measures. And here's an idea. Automate your savings by setting up a transfer to your business savings account each month. That way, you're steadily building your reserve without having to think about it. Again, this might be challenging with irregular income, but usually we can identify a minimum amount that we'd be able to transfer ongoing without concern. Okay, number 2, diversify your client base. Just like a well-balanced investment portfolio, a diversified client base can reduce your risk. Now, of course, a diversified portfolio does not assure a profit or protect against loss in declining markets, but there is an underlying principle that translates to types of clients or varied lines of business, and it's this. Whether it's a wider array of investments, a wider range of clients, or a broader range of services, what you're accomplishing is the ability to spread the risk. Try to avoid relying too heavily on a single client for your income. When you're spreading your efforts across multiple clients or client types or revenue streams, you reduce the impact of losing that one.
Sounds like a good strategy. Diversifying isn't just for investments, it's for clients too. What is that expression? Don't put all your eggs in one basket.
Right. If you have the ability to serve a variety of client types or curate different types of offerings, then incorporating this variety reduces your risk without taking away from your core offering. Like me, for example, I offer financial planning, but I have some clients who I only serve as a portfolio manager. And still there are others where I act as the agent on their life insurance, annuity, or their long-term care insurance policy. These are different types of products with different types of revenue. But in my work, they all serve the same purpose, which is getting to the core of serving my clients in the best possible manner that I am able to, making recommendations in their best interest, and helping them in their pursuit of retirement success. While there are many businesses that seem to fit a narrow or specific industry, let's say plumbing, for instance, there is a lot of variation within that industry. Do you serve commercial or residential properties? Is your business more oriented toward installation during a build or servicing maintenance requests? Or do you blend your service offerings, diversifying the different types of work you do and therefore having more service request options and the resulting different sources of revenue? Even though it's all the same business and from an outsider's perspective, the appearance of the same work. And third, separate personal and business finances. Protect your personal assets by keeping your business and personal finances separate. Consider forming an LLC or another legal structure that limits your personal liability. Additionally, make sure you have appropriate insurance coverage to protect against business-related risks. Here's a tip. A business credit card and a separate bank account are good starts. These not only help with tracking expenses, but also offer a layer of protection if something goes wrong. Navigating financial risks is about finding the right balance between risk and reward. While you want to protect your business from potential pitfalls, you also don't want to become so risk-averse that you stifle growth. Here's how to strike that balance. First, evaluate risk versus opportunity. Every business decision involves some level of risk. The key is to weigh the potential rewards against the risks. If the upside significantly outweighs the downside, it might be worth taking the leap. On the other hand, if the risk could derail your business, it might be better to steer clear. An example is if you're expanding into a new market and has the potential to double your revenue, but would require significant upfront investment, evaluate how this would impact your cash flow and overall financial health before proceeding. Second, use scenario planning. Scenario planning allows you to anticipate potential challenges and develop strategies to address them. By preparing for various what-if scenarios, you can navigate unforeseen challenges with greater confidence and adaptability. And here's a quick tip. Consider what you do if your top client suddenly left, if you faced an unexpected tax bill, or if your industry underwent a major change. Planning for these scenarios can help you pivot quickly when needed.
So, Philip, this is like plotting a course with multiple destinations in mind, right?
Exactly.
If a storm hits one, you've got another safe harbor to head to.
It's about trying to prepare for whatever the vast and sometimes unpredictable ocean of business tosses at you. Okay, and number 3, continuously review and adjust. Your business plan isn't a set it and forget it document. Regularly review your risk management strategies and adjust them as your business evolves. The risks you face today might be different from those you'll face next year, so stay proactive in managing them.
Here's a helpful AI pro tip. Set a reminder to review your financial risks quarterly or semi-annually. This regular check-in can help you stay ahead of potential problems and make adjustments before they become critical.
Great. Let's take some action on this. This week, take some time to assess. Seriously, if you've never done it, sit down and write these out. Assess all the financial risks you can think of that your business faces, and set a goal to implement at least one of the mitigation strategies we discussed today. Whether it's building your cash reserve, diversifying your client base, or separating your finances, these steps can help you navigate the choppy waters ahead. Okay, that's it for today. Thanks for tuning into this episode of The Financial Flow, brought to you by Tidepool Wealth Strategies. Until next time, stay resilient and plan to retire well. It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tidepool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon, 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity.